FinTech North was the Northeast Conference, which was the first Northeast Conference that we hosted. Some of you may have been there at Sage, in the old Sage offices, and so it's great to be running yet another event up here today, and also this afternoon on one of the panels we've got Sarat from Hedgehog Lab, and the very first FinTech North event that we hosted in Newcastle was hosted by Sarat and his team at Generator Studios. Which I guess must have been early 2019, I think. So maybe 2018 even. So yes, it's great to be back here today. Whitecap's had a few mentions today. So thank you very much to all the speakers that have given us a shout out. We're a strategy consultancy, and we do a lot of work on regional fintech, particularly looking at ecosystems and how to grow them. And we developed the Northeast Fintech strategy in partnership with some of the key stakeholders in this group. In the first session, it was brilliant to have so many national voices blended in with some of the key regional voices, and I think that's always an important feature of our conferences. And it's a real pleasure to continue that theme and welcome Phil Vidler from FinTech Growth Fund, who's travelled up from London to be with us today, and is going to talk to us about the work that the FinTech Growth Fund's doing. So, Phil, come on stage, and welcome back to FinTech North.
Thank you, Julian. Thank you to Joe and the rest of the FinTech North team for hosting and putting us on, and also giving me a few minutes to speak to you all. I'm going to try and keep this reasonably short to catch you up time and make sure you can kind of get on with the rest of the agenda. But there was two things I wanted to do. One, just for a minute or so, I'll just give a bit of background on who FGF are and what we do, and then also a bit of an ask for everybody in the audience as well, which will become clear as we get towards the end. So very similar to our CFIT friends that presented earlier today, the idea of FGF came out the back of the Khalifa Review in 2021. On the back of that, highlighting, or I suppose re-highlighting of the growth stage gap that we have in the UK. It's been a problem that's been talked about for a long time, and hopefully we're one of those steps to try and help fill that gap in the UK. So we are a growth stage fintech investor, purely focused on the UK market. What that means for us is we look at kind of Series B all the way up to pre-IPO, so businesses that are kind of 10 million plus in revenue, and similarly investing those kind of reasonably growth size checks, so between 10 and 50 million into businesses. We invest across the entirety of the kind of fintech ecosystem, so everything from those kind of traditional core banking capital markets all the way through to payments, wealth tech, reg tech, insurtech, etc., etc. And the slight difference that we have to some other funds is around the funding base that we potentially pull in, where the vast majority of our investors and the LPs into us are strategic institutions. So we launched at the end of last year with 5 that are now public. So it's Barclays, NatWest, MasterCard, and the Stock Exchange Group, and Peel Hunt. And MasterCard are here in the audience, signed earlier. And more to be announced soon. But really what that is and allows us to do is kind of really spend time with those institutions, really understand the problems that they're facing. And when it comes to then investment decisions, we'll be able to making those investment decisions and building up firms that we think then are ready to scale across those organisations. So it's not just the capital that we provide, but also hopefully that kind of distribution point as well for the firms that are part of our portfolio. The kind of other bit that I wanted to mention, which then comes onto the ask, is a programme that we launched, similarly actually at the FinTech North Conference in Leeds, I believe it was, kind of end of last year, start of this year, I can't remember where we were now, which is the Beyond Investing initiative that we've launched at FinTech Growth Fund. Beyond Investing is essentially our commitment and focus on to running a programme that is helping to grow the UK fintech sector outside of our direct investment remit. That's a programme that's initially looking at 3 key areas. The first being talent and D&I across both the fintech and VC space from themselves. The second being support for early stage founders and how we can try and help more firms that don't currently fit in the investment remit of the fund get there to that point of growth journey. And then the third is regionalisation and supporting the clusters like the Northeast, but across the entirety of the UK. Both ones already exist, but also the emergence of new clusters itself. So we launched a kind of pilot programme of that towards the end of last year. And the first event will be in Leeds, actually, in September. And that will kind of look at us ultimately how we can try and leverage the network that we have as a fund, which is a pleasant place of being the fact that as one of the only kind of growth stage firms in the UK, we have that good access across the entirety of both the earlier stage investment, but also the strategics that sit as part of it. So that event in Leeds, for example, working with Leeds University and the FinTech North team, obviously, we'll kind of cover a couple of different angles, but it will be both the incumbents that we'll look to bring. So there'll be at least, I think, 8 or 9, I think, on the current roster of kind of key decision makers within technology stacks of those businesses, the key kind of banks, insurers, asset managers that hopefully a lot of people want to sell into. A group of, I think we're up to 9 or 10 early stage investors. So it won't necessarily fit with our remit, but that kind of seed and Series A and also that start of Series B kind of investors that will also be joining us, as well as a number of the other kind of supportive networks to help firms fundraise and all that kind of stuff. So we'll be working with firms in Leeds in September. We'll be back up here in the Northeast, date TBC, but probably November as planned. So my ask for anybody is please kind of let us know how we can be helpful and who you might want us to kind of bring as part of that delegation that we're bringing up. We've kind of done a lot on obviously the earlier stage funding cycle before from some of the firms that we've been engaging in, but we're very happy to kind of be led by what the demand is and where the ask is. So please drop us an email, which is info@fintechgrowthfund.co.uk, and let us know what we can be doing to help and who we should bring up when we come up, and hopefully see you all in November. That was all I wanted to kind of say. Julian threatened to ask any questions if there was, but I don't know whether he wants to cut short and give you all back time. So I don't know whether that's it or whether you want to ask anything.
Has anyone got any questions for Phil? Phil, just one thing to get you to comment on before we move on. Earlier on we had the update from Peter at Innovate Finance on the funding landscape. What's your perspective on how the flow of funding is at the moment in general?
Yeah, so as everyone that's been raising or been engaging knows, it's been a bit of a weird and tough kind of 18 months or so. Obviously, when valuations change, inflation and enforced valuations change, VC's constricted quite a lot, as we all know. It's been a really tough 18 months. The step that's coming, and why I'm slightly more positive about that next year from that perspective, is that the kind of only worst thing I think that VCs often think about losing money on their investments is losing money in management fees. And it's getting to the end of those periods where they're going to need to deploy some capital. So, the big funds that were raised in kind of 2020, 2021 at the start of that, most of them are on 4 or 5 year investment cycles. They've ultimately paused for the last kind of 2-3 years, potentially some doubling down on their existing portfolios, but not much. As a result, there is a lot of dry powder out there. And, if they don't deploy it in the next kind of year, 18 months or so, they're going to lose those fees and ultimately lose the capital that's committed. So I do think there is and we're starting to see it a little bit. Same from the institutions where they're kind of really trying to work out where they're focusing on that perspective. But I think, generally, I think we've got a bit of an opportunity to be a bit more positive over the next kind of year or so from that side.
Okay, that sounds encouraging. The other thing that I keep reading is this sort of increased focus on the viability of businesses and revenue streams, and that they need to be stronger. So in order to utilize all that dry powder, presumably we're going to need a good supply of strong businesses as well, then.
Yeah, I think, anyone that's been speaking to investors over the last year, or even 18 months or coming up to 2 years, I suppose, will know that that dynamic has shifted. And, the requirement to have at least a kind of sight of profitability, or at least an idea of how you're going to get there at a reasonably quick turn, how you're not going to be burning cash continually, is even, it's just been doubled down on by investors from that perspective. Selfishly, from an investment perspective, it means that actually the firms that are here now and still going are in a much healthier place to be. And as a result, it makes them much more interesting and much more viable business to invest in. So I think if you've got through those last few years and you've managed to position yourself in a better route with a clear path to profitability and a kind of plan to get there, I think you should find it a lot easier as we move forward.
Cool. Brilliant. Thank you, Phil.
Cheers, Charles.
Okay, well, I think that sort of segues us brilliantly into the next slot. Let's hear from a business that's not only a Northeast business, but ticks all the boxes that Phil just said about building a viable business model and growing and attracting investment. Delighted to welcome Roger from Canny, one of the sort of stars of the FinTech ecosystem in the Northeast. Hi, Roger.
Morning, everyone. Hopefully you can hear me. Phil's words were really, really true. We survived, which is why I'm here. So hopefully I'm going to give you a slightly different perspective today, maybe some takeaways. I've got a lot to cram in, so forgive me if I'm a little bit quick. But if you want to talk a bit more about anything that I talk about during this presentation, then obviously we've got lunch and other things going on. Quick shout out to Dialect who are in the audience as well. We share an investor, so hello to Neil out there. He asked me to do that just before I came up, so get that one out of the way, tick. Right, who are we? So I am talking about, how does this work? There we go. How does it work? Where is the, oh, there's the controller will be useful, there we go. No, there we go, good, right, so scaling up. What I'm going to talk about really is the behaviours and the changes that happen when you move from startup to scale up. And it's an interesting stage. It's not often obvious when it happens. And so I'm going to talk about some of the insights. But first of all, I think what we'll do is just talk about who we are very briefly. Canny effectively started in 2018. We're a FinTech business who support payment companies, and I'll talk a little bit about what we do. But we were started and founded in 2018 by our now CEO. But he has got a history in the Northeast, so we're a Northeast-based business based in Newcastle. He'd come off three. This is his third company that he's been involved in this part of the world. And he saw a gap in the market for reconciliation, analytics, and some data management that was frustrating him. So his role at the time in previous companies was to try and manipulate and get out some reports for clients. And that was a problem. So he built a business in that space. He saw the gap and built this business, which is Canny. So it was born out of frustration more than anything else. We've got clients all around the world. So we've gone through the startup phase of validating the product. And we've got people as far as Australia, South America, and quite a few in Europe and UK. We are based in the Northeast, but we do have a distributed workforce. So we have people remote working. The majority of people are up here. This is effectively what we do. This is a very simple picture of our platform. So reconciliation, compliance reporting, and business analytics. It's a problem for so many companies, and every conversation we have generally ends in the same sort of place. People are trying to scale. They're trying to find a solution to manual work or semi-automated work. Everyone's working off Excel or slightly different products, and that's where we step in. So our platform effectively deals with very high volumes of data with lots of complexity at a very, very rapid pace. And effectively, we ingest data from card networks, processors, and we can take in ledger data and we can normalize it so that reports come out the other end. Effectively, we work with lots of different types of companies, so acquirers, issuers, payment plan operators, and banks, neobanks, etc. So we've got a wide portfolio of clients. Now, we specialize and support, and we've made it really clear, payment companies. There was a point at which we talked about, actually, do we diversify? Do we think about insurance or the other things? And I think that's an important point about scaling up. You've got to decide where to play. And if anyone's studied marketing, where to play is one of the biggest questions you have to answer pretty early on. So I'm going to talk about the transition. So when do you know when you're transitioning from startup to scale up? Usually, and I think we've had some people talking about it already, it's usually when the tipping point comes when investment's needed or arrives, comes knocking on the door, where profit or sales get to a point where you think actually now is the right point, where you're sort of coming round to that profitability stage, or you can see it, or your customer numbers are increasing. So it's not all of those things, it's not some of those things, it could be a combination, and it could be other factors as well. But knowing it and spotting it is actually quite difficult, and it will be different for every type of business. But the first thing that we did when we reached that point where we had the realization that we're not a startup anymore, we've got to start moving, is we had a strategy review, and I'll talk a little bit about that. Within the strategy review, you talk about the aims, what your objectives are, whether that's an investor objective or a customer objective. It's really clear that you get those things nailed down. And then the other bit that we had a conversation around, and again, I think people might have struggled with this over time. Are you a customer-led business, a product-led business, or a brand-led business? Now, that is one debate you don't really want to go into too deeply because it takes forever, and the conclusion, there never really is one. Now, the good thing is we did that, and we kind of came up with this sort of hybrid space where we wanted scalable growth. We wanted to be insight-driven, so we wanted to use customers to help us improve our platform. and we wanted to get to a point where we've got low touch sales. So at the moment, we're coming out of a high touch period, but we want to go into a low touch sales period. And I'll explain a little bit about what that looks like. But the typical questions, if you sit in a room and start asking yourself some odd questions, these are the sort of things that come across the table. So, the way we're working isn't scalable. We know what we need to do. We know where we need to get to. But if we doubled our customer base right now, we couldn't handle it. And that's very, very typical. And the challenge with that, and it comes a bit later, is once you put the pedal down on sales and the customers arrive, the back end isn't usually ready. And that's the bit you've got to get your head around. So there's a couple more slides in here that we'll dig in. But the biggest part of this is time is the enemy here. Time is the thing you do not have enough of. And I didn't really appreciate it until I really started working in this business. I came from quite a big corporate background and came into this environment. Time is the biggest enemy you've got. So general behaviours. This is where we're going to start. So these are the general behaviours of startups. So what you can see here, you go from a product validation standpoint to a point at which you know what your product is, and you've got to get scaling. You've got to shift towards processes. I mean, a lot of this is not really process driven. It's sticky tape and plasters across different processes to get across the line to benefit. And then expanding your customer base. If you look at the early days of Canny, we started with a few customers. We validated the product. We got it right. We changed it. Someone talked a little bit earlier in the curve where you pivot a bit. That's all happened. And then you get to this point where you've really got to shift from one side to the other. And the four things that are really important at this point are your business strategy, your targets, long and short, because up until that point, a lot of your targets have been quite short. You've got to get into the long term, particularly if you're going to look at external investment. KPIs and OKRs, whatever you want to call them, it doesn't matter. The definitions are slightly different, but you do have to have some metrics. And there's loads of metrics in a business, sometimes too many. And one of the things I was working on with the team is to dial it right back. What are the things that are really important? Because the other things will add up to those anyway. And then rhythm. The rhythm of the business changes. It becomes more intense because you're bringing more people on and the pressures come. And that brings its own challenges. On a strategy question, for example, one of the questions we had, and again, I don't know if this resonates with anyone here, but you get to a point where you say, do I want lots of small customers or do I want to land some bigger ones? They're different. They need different handling. The bigger ones need account management, all that sort of stuff. I mean, obviously we account manage small, but the large ones have a much higher demand. And then obviously partnerships come on the table. How do we use the partnership route to try and boost our volumes? We work with the networks very clearly. We work with lots of processors as well. And they've got customers that could be our customers. So that's an obvious area for us to have leveraged. The two sort of takeaways on this slide. Dynamic growth is really important. What does that really mean? That means you can't just use a single track. You've got to have a couple of tracks going at once. You've got to have a short plan, things you need to get done, and a long plan which gets you to the goal. And so dynamic growth is something that we talk about a lot at Canny. And then the longer view around the rhythm. So generally, all of this splits into the behaviours, which is what I was talking about. These are the 6 behaviours. I'm not going to talk about investors. Probably not the right thing, and you've heard a lot about investors already. So I'm going to focus on the other ones, and I'm going to give you a few insights into the things that I had to deal with and things that we're still dealing with in terms of that shift from startup to scale up. So typically, resource allocation, shift in mindset, diverting funds. This is what happens. You start down here, you're trying things, it's risk, but it might be a reward. When you get into the scale up stage, if you have got external investment or you are bringing on more clients, the pressure is leaning much more towards sales, marketing and customer success. For me, I think it's more sales and customer success. From a marketing point of view, if you've got enough demand coming in, there are other roles for marketing, but maybe they're a bit later. This all comes down to having a really valid business plan. And the point here in terms of investing in the product development part, build what you can sell, not what you think people want to buy. So we spend a lot of time talking to our customers and listening, really, really, really listening to them about what they need. And then we'll go and build a product in that space or adjust the product we've got to fix that. When we do that, really important point that comes a bit later is about the scalability. Don't build it just for them, build it for everyone else, because otherwise you end up bespoking your product more than you actually need to. Getting the right people. So my sort of key areas here, getting the right people, really important. Not everyone's going to make it. People who are with you in the startup phase aren't necessarily the right people for scale up, and it might not be the right place for them either. It's uncomfortable, it's difficult, there's a lot of pressure. And also, I'll talk about it in a minute, but you move from a sort of generalist environment to a specialist environment. And again, that doesn't always suit the people that were on the early part of the journey. Reviewing agencies, and this is really from a sort of PR and comms point of view. There are a couple of other agencies that I'm talking about as well in this respect. But effectively, if you've kind of got this far with the people you've got, usually you've done it on a bit of a shoestring budget, and you didn't really need a lot of help because you've leveraged your network to get the sales and the various events. When you start to scale up, you need more professional agencies, people who are specialists in different things, social media, for example, or digital marketing, or web development. They might not be the same people. So a thorough review of agencies is something that the scale-up journey requires. And then value for money. Every pound is precious. Every single pound is precious. I've made some very difficult decisions about things that we've done in the past that we're not doing in the future. They don't feel natural, but we have got to guard every pound and invest it in a place where we know we can get it back. And the second to last point, external image. I think as you grow, you've got to look bigger than you actually are. You've got to do that now. So you've got to turn up to an event and people have got to think that you are probably 5 or 10 times bigger than you actually are, but you're not. So that's a real skill. It's not difficult to do, but it takes some thinking. And time planning, I think, is the other one on here. Quality touch points is the same as showing up well. Customer acquisition strategy, probably the most important one, I would say, depending on where you sit in the organisation, of course, but arguably the most crucial. For me, it's a relentless area. This is an area where if you get it wrong, the rest of it doesn't work because there's no money to pay any of the bills and your investment starts to become a bit pressurised. So your go-to-market strategy is really important. You've got to decide which channels you're going to be in, which ones are important. And for us, for example, a lot of our inquiries and our new business was developed through networks that we had already, partnerships that we had already, and people that we knew or events that we'd been to where we'd picked up really good contacts. That's going to run out, right? So you've got to accept the fact it's going to run out at some point, and you're going to have to rely on the discipline of marketing to pump inquiries into your business. So that means you need a website that becomes a demand engine rather than just a face of the business. And you've got to try and turn the lens the other way around. Rather than it being a sales-led business, try and get it to be a marketing-led business. That does take time, it takes planning. It will take a few months, if not a year or so to do, but it is definitely the place to get to. And I also think that when you get to an investment position, in front of an external investor, a business that has a demand generation engine that's marketing-led is far more attractive than one is sales-led. A lot of sales-led businesses that I know use external agencies to drive their sales inbound leads, which is a good tactic, but it can't last forever. And really, it gets quite expensive as well. So go-to-market is key. Listening to customers. So on the side here, we've got listening to customers. We listen to our customers, we do surveys with them. That gives us, content for marketing and PR, but also it gives us feedback for the development teams. Scaling sales, people, agents, long-term view. Those are the things you've got to look at. Have you got the right people? Are they got the right skills? If you're going to need people in advance, always plan that 3-month, maybe 6-month window to attract the right person into your business. Technology was one that I hadn't appreciated enough before I arrived here. Technology from a sort of sales point of view, whether it's a CRM system or the website itself, you've got to get that right. Is LinkedIn Sales Navigator the right tool for you? Again, I've spoken to lots of people who are experts on LinkedIn Sales Navigator, and if you've ever done it, it's mind-blowing what that tool is capable of. But actually, it might be too much. You might not need that. It might be that the volume that's in there might be too much for you to handle at this point, so therefore it might be a different strategy. Maybe that's one for a bit later on. And that was a decision we made. It is one for later on. It's not one for now. We still use LinkedIn, but we don't use all the full functionality of Sales Navigator. Big area that you do need to work on, or we worked on, pricing. So we're a SaaS business, so we use a SaaS model. It's a tiered model. And when Canny was first formed, we used to price in terms of user seats and data volumes and all that. It's so confusing. Now we price by tier and we price by functionality, and it's effectively an all-you-can-eat within those tiers. There are some elements around support hours that we can bolt on after, but effectively we've simplified the business by changing the way that we price, and our customers understand it much easier, much quicker. They know where they are. They start to position themselves in the tiers themselves, which is pretty good. Key point that I made earlier, the volume pushes the pressure to the back end. So effectively, if you're going to put the hammer down on sales, you need to make sure you've got customer success people at the back. And again, that's what we did. We looked at that because we knew that it was going to be a problem. Risk tolerance. So again, simple thing. More customers cannot drive linear costs, right? It's really, really important. You can't just keep piling customers in and just add people on just to make sure you can cope with them. How do you do that? I mean, you've got to know what works. You've got to get to the point where you've got sustainability and scalability, and some of that comes from building to scale. So our platform, we want to try and simplify the way the platform works and build in self-serving capabilities so that the customers can serve themselves. Now, what that also means is you need to provide manuals, guides, how-tos, et cetera. So, I was talking to someone earlier about when you buy a phone these days, you don't get a manual with it, right? Just think of that. That's what you want to get to, where you buy that phone and it kind of does it all for you. So out of the box. Now, we're not there yet, but we're certainly on that journey. And that is a route to scalability. There will be some bespoke stuff that you'll need to look at. Well, certainly we will. But it should be relatively small. Narrowing the target. For us, we know who our customers are, and we're going for them. We're not going to try and find other people. There's enough audience sizes within our core targets on our exact target matching that we don't need to look elsewhere. So we're very, very focused on our targets. And from a sort of scalability and sustainability, we're ticking the boxes in that respect. Depth of people is key. So as you scale, you need more depth of support. So, we're in August almost, holiday period. You've got to plan around that. I know it's simple stuff, but in a small business, if 2 people go on holiday and they're quite key to the business, you could be in trouble quite quickly. So those are sort of simple things that we looked at. Product simplification we've talked about. Reducing that friction as well. So ultimately, we would like people to buy straight off our website, right? Why can't you buy Canny directly from the website, press the button, off you go? Ultimately, could we get there? Maybe. But it's my vision for our website, and again, it's part of this scalability element, is for the website to be the best salesperson we've got. That's the vision, right? It's not, I can tell you that now. But that is the vision, to make that website the best salesperson we've got. Planning ahead for the volume is key. Right, company culture. This is a real thorny subject. Not everyone will make it. Really important point. What happens is, as I said earlier, you start with a bunch of generalists. Obviously, they have specialist knowledge, but they're used to wearing multiple hats. As the business scales and expands, you get more disciplines, more functions. Some of those hats get removed, and people don't like that. They like to have the bandwidth that they had before, and that could be destabilizing within the business. So we need to think of that and change of journey. So we put in a number of things. Getting the right people comes back again. Specialization, you've got to get the right people in the right places. For example, if you need a digital marketing specialist or a marketing specialist or a brand marketing specialist, go and get one. If you need a web company to support that and you need someone to run that agency, then go and get that if you can justify it through your P&L and your ROI. Core groups, what tends to happen and again for us, as we've got bigger, you end up getting some steercos suddenly start emerging where you've got smaller groups of people deciding the shape and the direction of the work that needs to come out. That is so crucial. You cannot, my description here is if you go and watch an under-11s football match, they are all following the ball at the same time. Every player, they're all following the ball. You can't do that in a big company or in a scaling up company. You have to let the right people do their jobs. And the decision making also is not always inclusive. Whereas as Canny was scaling, there was a core group of people that were involved in every decision, every hire, et cetera. That's not sustainable in the future. You know, if you are the commercial or the development head and you need a developer, you shouldn't really need the permission of someone who's not in the development group to get that person. And I think these are simple teething problems that happen as you grow. Leadership styles, I've got 30 seconds. Leadership styles, let leaders lead, right? Let leaders lead. It's so important. I've seen it in Canny and we're doing it. But it's tough for a few people to sort of let go a little bit, but let leaders lead. Dispersed authority, or however you want to describe it, is really important. The key takeaways on this one, change management is going to happen. You've got to be ready for it. Over communication is the key to managing that with the people. And shifting from tactical to strategic as a business and a leadership style, start talking strategy, start talking longer term rather than what we're doing today and tomorrow. They've got to hear that within the teams as well. On new processes, there's always new stuff. People don't find it. You know, you get a bit of non-compliance. For us, the bigger you get, the more process you need, because we've got more customers to satisfy and there's more things that can go wrong. And on that point, breakages, processes, people and systems are the three things that tend to break. Processes, people and systems. So those things you've got to guard with your life. Planning and thinking time goes back to my message at the beginning. Time is your enemy. The two things that I think from a leadership team that we've done differently and are continuing to do within Canny at the moment is spending more time on planning and thinking together as a group, and then we go and execute. It saves so many other conversations. I'm way out of time, but my biggest pieces of advice: hold your nerve, definitely hold your nerve. Stay focused on the goal that you set out in your scale-up journey, and stick to that plan. The pace is everything. Someone's got to set the pace. Someone's got to crack the whip. And if no one's doing that, you can drift a little bit. So someone's got to take that lead. And my last point, I've said it a few times, which is time is the enemy, definitely. Hopefully that was quite useful. If anyone's got any questions, I'll take them.
Well, that was fantastic. Time is, as event managers, time is our enemy as well, Roger. So hence no questions, but I'm sure you'll be happy to take them in the break. And I'll just say as well, we did a report on scale-ups last year, or earlier this year as Whitecap, and everything Roger's just presented is exactly on the money for what we heard and found in that report. So that was a really strong insight into what you need to do to scale up. So back to Joe. Joe, I'll let you take over. Have I got the right slide? I do, yeah. We're going to have a fireside chat now, hosted by Joe Roche of FinTech North.
Thank you very much, Julian. If I could ask Keith and Mark to join me up on the stage once Julian's cleared the way, that would be awesome. MasterCard are one of our strategic partners at FinTech North, as I'm sure you're all aware, and really play a really pivotal role in helping us to shape the content and keep you all engaged. So delighted to be joined by Mark and obviously Keith here today. So please, why don't you both introduce yourselves? Introduce yourself to our community. Thank you.
Shall I go first? This is working, right? Yeah, hi. My name is Mark Greenberg. I work for Vocalink. We are part of the MasterCard family, but my role is in the analysis and processing of payment data that is account to account. So whilst MasterCard is, obviously a huge company in card payments, Vocalink specializes in account-to-account payments through the BACS, faster payments and check clearing systems, which enables us to gather sort of 10 to 12 billion payment records a year, sits in a big database, and we spent years trying to get insights out of that with the express permission of the owners of that data. I can go into a bit more detail later, but essentially we don't own the data, and everything we do is under very strict guidelines.
And you, Keith?
Yeah, hi, my name is Keith. So I'm a senior economist from the Office for National Statistics. I have been sort of working there for 8 years or so. For the last 5 years, before COVID, started sort of working on a program of work that sort of closely sort of links to the sort of payment industry, working with the likes of Visa card, as well as sort of MasterCards through Vocalink to understand and explore the public value of payments data. And sort of our collaboration has basically sort of led us to this talk today.
So on that note, how did you both start working together?
As I mentioned, I mean, I've been processing this data for kind of getting insights out of it for a long, long time. But what happened, I think, that changed everything really was that when COVID hit, it was about, I think, the sort of third week of March 2020, the first lockdown had been announced. Vocalink got a call from number 10 somewhere. Not exactly sure who that was, but the government was saying, we're about to go into lockdown. We're going to be looking for ways of supporting businesses and individuals with various financial support schemes. We're going to need a lot of help to understand the impact on the economy, on businesses, and on people. And literally over one weekend, permissions which normally take months to gather were secured, and we started analyzing the data in ways that we hadn't really been kind of allowed to do before. At that point, we started daily reporting to the Treasury, to other government departments, and mainly to the Office for National Statistics, during which we uncovered a number of quite interesting findings to do with kind of payment patterns. One of the first things we discovered, which I think people were surprised about, was people's direct debits. The rate of unpaids of direct debits suddenly went down as I think people's regular bills were, many regular bills were being ceased. So people's gym memberships were being ceased, and various expenditure which you were no longer able to make in COVID times meant that people actually, against what you might have expected, had more disposable income. I mean, this is a kind of generalization, and unpaid rates went down. But we continue to provide analyses of that sort and through various data science and analytical techniques. And I think as a result of that, and some of the reporting that went through, the ONS really picked up on it and asked a whole load of additional questions.
Yeah, I'd just like to add that, particularly during COVID, it was a really challenging times for sort of many public service. And in the ONS, we face a particular challenge around producing sort of the statistics, in the way that we've always done. So for those who don't know, sort of ONS is the largest independent statistics producer in the UK. We are a non-ministerial government, so we're independent, but we're part of the government, and we produce important numbers like GDP and, for example, inflation this morning, which obviously is woven into sort of everyday life. And during COVID, it was a real challenge because a lot of our sort of statistics, believe it or not, have been based on very traditional data collection methods, like going out sort of doing surveys, or with prices, going out and field interviewer, like going to shops, like taking note of the prices, in stores, that sort of things. Obviously, during COVID, that wasn't possible, and that sort of presented huge challenges to us to produce those statistics, which in turn, would have a huge knock-on impact on everybody who rely on having those statistics to make decisions. And so, sort of, we set out on this quest, for timely, really good alternative data that are not necessarily representative of the things that we want to measure, like GDP or inflation, but they are sort of good enough and sort of suggestive enough that gives us a real-time sense of the direction of travel and help us sort of plug sort of gaps while we sort of figure out, like in a very short space, like what we needed to do in response to a really sort of fast-changing situation. So, in that sort of sense, I think the ONS and probably the public, would be very grateful to the sort of public sort of private sort of partnership that we managed to set out, like Mark sort of said, like we managed to push through like agreeing sort of arrangements that probably would have taken sort of in normal times years to make. We make those sort of agreements sort of very quickly, and sort of data insights started sort of coming through to government, through ONS. And obviously, since then we've realized sort of the long-term benefits of those data and insights, and now, obviously, then cost of living happened. It's a completely different set of challenges. But like Mark said, with COVID, it sort of kickstart like a new era of sort of collaboration that extends into sort of current space, and hopefully we will see some of the really interesting insights in a few moments.
Yeah, I was going to say that the payment data we have, which sounds like the most wonderful data source you could possibly imagine, with, as I said, 10 to 12 billion payment records a year, is in a sense not that exciting, because it's quite narrow. It contains only the information that is required for a payment to go through. So what we've been working on together, and actually prior to this arrangement, has been devising ways of inferring whether payments have been made between individuals or between businesses and individuals, and kind of all the combinations, and for businesses, what industry they're in. And once we understand what industries are involved, to try and understand a bit more about, well, are these payments actually life insurance premiums, or household insurance premiums, or utility bills, or subscriptions for a gym that I mentioned earlier. And so we've developed quite a number of inference techniques so that we can actually understand what the payments really mean. And kind of without that, the payment information is kind of a little bit bland.
So Keith, I've got some slides that you sent through to us. You just let me know when you want me to put them up on the screen behind us. We're kind of digging into this now, aren't we? And you've touched upon there about the data that you've got at your disposal. Is there anything else you want to add to that, or shall I move on to kind of the impact of your work?
Yeah, let's move on.
Yeah. Well, what has been the impact?
Yeah, perhaps like it would be a good time to flick through sort of the next few slides, just to show so some of the highlights really. I mean, Mark already sort of covered the initial insights from COVID, where sort of direct debit failure rates sort of dropped, and then after that we had the cost of living crisis, and as you expect, things got more expensive, and it was more difficult for people to pay, and the direct debit failure rates, since then have been sort of increasing. It's worth saying, sort of the Vocalink data, obviously, it's, you will all know sort of your data is super timely. And that's a real strength, compared to, something like GDP statistics, where, we typically, being one of the fastest in the world already, we typically publish about like 6 weeks after a month has ended. So, around this time, I think soon we'll find out sort of what the GDP number was in May, but, I feel like ages ago, but yeah, we're able to sort of extract like real-time insights from this data. So, looking at direct debit sort of failures and sort of reason for that, for example, this chart here shows the indexed average transaction amount of direct debit payments for a different type of transactions. And so you see, a really interesting picture, obviously, for much of sort of the first part of the cost of living crisis. It started because of the war in Ukraine and sort of energy prices going up. So you clearly see that sort of the light blue line there, electricity and gas payments sort of went up very quickly in a very short space. But since then, it's actually coming back down. But more recently, we see sort of other sort of financial sort of pressures on people, through, for example, water bills. The orange line there is starting to go up. There's quite a lot of news like recently about water companies. And the increase in interest rate, obviously you expect sort of to feed through to things like loans and mortgages, repayments, and you see that clearly they're going up. So that's really powerful, interesting, real-time insights about sort of consumers that have sort of massive like public value. On to the next slide. So this is some of the sort of more in-depth work that sort of Mark spoke about. It's a joint sort of collaboration between ONS and sort of Vocalink, using data science, like Mark said, to figure out, sort of different account types, what industries they are. So by the way, I should say the last slide, the data is published monthly, so you could go to the ONS website and look at that your own time. But last December, we published a piece called Industry to Industry Payment Flows. Basically, we use a sample of sort of known accounts in the Vocalink sort of payments data, in the BACS payments data, and we sort of assign a industrial code to those accounts, and we work out the payments between them over a very long period of time. And therefore, we came up with this sort of you like a heat map of how industries are paying each other and the interactions between them. And we move on to the next slide, just to highlight an example. We had the energy price shock, and the government was thinking about, okay, we need to support businesses, who to support, who is in need. And using this sort of data, well, first of all, we see that the volume of payments that firms are making to energy firms, the light blue line on the left is fairly steady, but you see sort of the jump in the amount that they pay, has gone up a lot in a very short time. So who is being affected? Using that sort of inter-industry matrix, we could look at the share of energy payments as a proportion of total payments. We look at that sort of by different industries and who has sort of has been impacted the most. And you can see on the right there, interestingly, sort of the most impacted industries are those that have, like, if you like, medium energy intensity. So the super high ones and the low ones don't seem to be affected that much by the high energy, the energy price shocks. Perhaps they found ways to mitigate it or respond to it, but it's sort of the medium energy intensive industries that got affected the most. And obviously that had a lot of like really useful, powerful policy insights that were otherwise sort of not available in traditional data sources. And just a very sort of final word on the final slide, just looking ahead on what we can expect next. We're in Newcastle, and there's a very heavy sort of northeast sort of flavor to this, which is fantastic. ONS does there's a huge amount of work going on in ONS about like providing some national statistics, and this program of work that I've just sort of showed you, very similarly, we're working together, to hopefully, in the next 6 months, no promises, but looking to add regional classifications to the data so that we are able to see sort of the flows of payments between different industries as well as regions in the UK, and obviously that's super sort of powerful and pretty unprecedented. We, amongst other things, possibly, we might want to look at these sort of interactions by firm size, alongside location and industry. For example, we want to look at green industries and sort of how we support that. There are a lot of like really interesting insights that are coming out, but at the heart of ONS, we want to improve the official statistics that we produce. So we're thinking of ways how we can, bring some of these into the official GDP measurement, but as well as other policy uses. So, in short, this sort of, public-private sort of partnerships, has been extremely sort of powerful, and so it's credit to everybody that's been involved, to support this, to make it happen.
Anything to add, Mark?
Well, not really. I mean, I think we've all found it an extremely interesting exercise, and Vocalink through MasterCard is supporting this work in the kind of furtherance of the national interest, and Vocalink, MasterCard in particular, actually has a kind of a phrase about doing well by doing good, and this is part of that.
Awesome. Just coming up to time now. Has anyone in the audience got any questions? I think we've got a microphone down there if anyone would like to ask a question of Mark or Keith. We've got one just in the back row here.
If you could add any data point into the data, what would it be and why?
No worries. If you could add any data point in the data you receive through payment rails, what would it be and why?
I think one of the things that would be really interesting, and I think at the moment is a bit difficult, would be to merge the account to account payment data that we've been talking about with the card data, because the account to account data essentially covers people's income almost exclusively. I mean, almost all of people's income is covered, and almost all of people's kind of regular bills. But what we don't really have a handle on through those payment methods is discretionary spend. So I think maybe to bring the whole lot together would give us an even fuller kind of view of the economy.
Yeah, I think something akin to like open banking data would be very powerful. I think the obvious thing that's missing, from all this is like, demographics. It's something that ONS, a lot of our work, cares about demographics. The census is all about demographics. But obviously, in this data, it's actually quite hard to figure out, who are in the same household. Sometimes one account would pay for certain things, and sort of the spouse would pay for other things. So how do we group things? Can we classify things by different characteristics so that we can better understand sort of the fabric of society and economy. But yeah, my wish list is very long. But yeah.
But in the meantime, we're building models to infer that stuff.
Yeah.
Awesome. Can we have a big round of applause for Mark and Keith, everybody?
Well, that was great. Thank you very much, guys. It's always great to hear from MasterCard, and particularly VocaLink. We've got strong roots in the north. I think there's roots between ONS and Durham as well. That NOMIS, the service that ONS offers, is managed by Durham University, as far as I understand it. That's still correct. Okay. Gela, welcome. Welcome back. Anyone that's been at our conferences over the last year or so may well have heard from Gela before from FData. You're just gonna kick me off, aren't you?
No, I'm gonna ask for the little flipper
You
thing.
want that?
Oh, look, it's tiny and narrow.
Okay. And you've got the timer down here, okay?
Sure. Which is up and down. Look, I'm blind. I'm pretty much deaf and dumb. So this is going to be an interesting experiment. I literally can't see you. It's part the lighting. It's also part the glasses. I'm Gela. Let's see. There we go. Actually, before I start, I want to add a testimonial to a couple of things. 2 different programs, which I highly encourage you to participate in or get involved in or at least follow. One is CFIT. I had the privilege of being part of the original partnership for the Open Finance Sprint and the coalition, and was intimately involved in developing some of the consent model discussion. A number of my members, I am the head of the Financial Data and Technology Association. We represent practitioners of open banking / open finance in the market, both here and in Europe and globally. A number of my members also participated in that coalition. And quite frankly, the rigorous thought that is given to the problem at hand and the use cases is incredible. And the collaborative environment is absolutely fantastic. And the team that runs CFIT, top notch. They're welcoming of dissent, they're welcoming of debate, and they're welcoming of challenge, which is exactly what we need in order to further the work that we're doing inside of Open Finance. I'm very much looking forward to participating in the Fraud Prevention Coalition as well. The second thing I want to encourage you to do is really take a look at what the FCA is doing. Their innovation team I have worked with for a number of years. In fact, I actually used to harass Nick Cook, who was the original head of RegTech that started the innovation department back in the day. Poor chap, still hears from me on occasion. And I routinely harass the innovation team as they well can testify. And poor Helena, I even harassed her when she was the policy side of the FCA. So you have not escaped, my friend. I will hunt you down. In any case, the work that they are doing is absolutely phenomenal. What they've developed along the digital sandbox, the innovation pathways, and the regulatory sandbox is incredible. For a firm to have that first-hand insight into what they can do in the market, What actually has impact in customers, either using the synthetic data or testing a live beta with live customers in proportion. And being able to go through that exercise is incredible in accelerating the ability to launch the right product market fit solution. The other thing that's fun are the tech sprints. If you haven't been involved in a tech sprint, I highly encourage you to do that. It's either a 2 or 3 day session in person down in London, but you are on a team that really goes through the exercise of testing an idea from ideation, concept, all the way through to designing even wireframes and then pitching it to a judging panel. If you're not available, or if your time doesn't permit to do an in-person tech sprint, look at the longer digital tech sprints. Those are 3 months in duration. You collaborate with a team that is pieced together from across the country, sometimes an international team. You have an opportunity to make new connections, to also make new connections for your ideas, your solutions, your go-to-market strategy, your pricing, and your pitching. And you get support from the rest of the ecosystem. It's not just about the teams in the room. It's about the FCA's ability to convene an entire ecosystem to support the idea. You're contributing to the general thought process, but you're also getting some very interesting and quite relevant experience in how to do entrepreneurship inside of a theoretical space. But it's a phenomenal program, and I have the privilege of being very, very intimately involved in them. What I'm saying is if you show up for one of those, there's a very good chance I'm going to show up inside the room and harass you too. You'd love it. People come back for more. True story. In any case, let's get on to this. The future of finance, or the future of FinTech is not finance. That may seem a bit audacious, but I propose that it's actually true. And why do I say this? I say it clearly technology doesn't love me. Here we go. Ha! You've heard some people reference this. Open finance, or smart data. In fact, it actually is around the edges of finance that we find the future for FinTech, because the future is very much about open. It is about data sharing, and it's about intersectionality. And if you haven't checked out something called smart data, I invite you to sit back, listen, enjoy, and then hunt after we leave the room. Finance is really just a fraction of this. Maybe I'll move so some people can actually see the screen. Oh, mud on. There we go. Data sharing. We've talked about it in a random sort of approach. I want to formalize this. Data sharing economies are the next wave of digital growth, of economic growth, of GDP, and general economic building. Open banking was the first formalized with an actual regulatory framework, a legal framework, and a legislative mandate to enable data sharing. It was the very first business model put into practice. And it has been incredibly successful, especially in the UK. We were one of the very first leading countries to do this. It came off the back of something called PSD2, the Payment Services Directive. And in fact, we have someone in the room that was instrumental in helping shape that, as well as write the regulatory technical standards. But this experiment was rolled out back in 2016. It had been argued about for a number of years, but it started to be formalized in terms of passing parliament and in terms of being adopted onshore in 2017. And in 2018, we began the very difficult work of building the delivery mechanisms that allowed for data sharing. It included building infrastructure, creating a liability model, looking at consent and permissions management, and having a technical structure that allowed for the safety and security of that data to be shared in a way that ensured privacy and had top-notch security. And all of you know what that is. That's an API. But open banking has had extraordinary adoption in the UK. We're around 11 million active users monthly. We are upwards of 11 to 12 billion transactions or data sharing experiences per month, and it continues to grow. It's also been something that's adopted globally. In fact, it's around 120 countries that have formal legislation, and they're at various points in their own delivery journey. But even that reticent market that exceptional market, that crazy market, the US has decided to formalize this. So even one of the last major developed economies has decided that formalized data sharing is the next phase of growth. And the US is actually undertaking this in their notice of proposed rulemaking for Section 1033 of the Dodd-Frank Act. For us, it was the 2017 retail order from the Competitions and Market Authority that formalized this. And we've been delivering on it ever since. There is something now that we've reintroduced, and actually I'm very excited to see what the King's Speech has to say today, because we anticipate that it will be reintroduced into this next parliamentary session, and that is the UK's National Smart Data Scheme. It was previously under the guise of the Data Protection and Digital Innovations Bill. Unfortunately, that didn't quite make it through Lords before the election was called. We anticipate that it will be reintroduced in some guise. I'm hoping, quite frankly, that it's a standalone bill, because the smart data clause in that previous legislation was only 17 clauses or 17 lines long. And what it does is sets up a formalized approach to opening up every other type of sector, starting with a few different things. Oh, they were actually up on the screen already. Let's see if we can do this. Basta. I'm sorry, this is terrible. In any case, we're looking at retail, transportation, mortgages, energy, and one other. And I don't remember. Transportation, did I already mention that? This is also what happens when you get old. Your memory gets foggy. So there's a fifth pillar that I don't remember, but finance is also included. And in fact, what we were waiting for from the smart data scheme was for that primary legislation to then enable each different sector to kick off their own secondary legislation that would allow them to formalize the opening up for their specific sector. As each one of those different sectors have different needs and requirements, there would be a common approach across them on a common infrastructure that allowed for interoperability from the technical perspective and from the data standards perspective. And it would start to allow us to do some interesting experiment on intersectional data. And some of the use cases that are actually live in market and being worked on are here on screen. In fact, I'm also involved in the Perseus project, which is where energy data is actually being ingested and used from the cloud accounting platforms to the carbon accounting platforms and the banks who are financing a lot of SMEs and businesses and allowing them to better report on their carbon impact. It's a regulatory requirement to do this reporting, but there's no formal, standardized, or automated way to do that. And so we're working on how we can actually start to ingest that data to ensure that, again, certain components are in place, like a liability model if something goes a little bit wrong, about data standards, about technical standards, about consent and permission, and about the data attributes in particular that need to be exchanged and identifying those in the project. If we look at another sector, we're looking at, say, land registries and open property. Imagine if you were going out for a mortgage today and we're actually able to automate all of the legal requirements, the conveyance, the surveillance, the state of the home or the building, and to automate all of that to expedite the financing. But also imagine if your bank were actually able to look at all of that information and assess the risk more accurately, and then reshape the mortgage to fit the actual risk of the property. Not just your ability to finance it, but the understanding of what that ownership of the piece of property actually will have on your finances. But also imagine not taking 6 months to do it, instead 6 weeks. These are the kind of things that we're already exploring under the open property approach, but under smart data, this would become a real thing, and it would actually be in place in pretty much every financial institution. The other part is green financing for homes and for upgrades, for buildings, putting solar on the roof, adding additional insulation, changing out the windows. All of those little bits and pieces start to add up, but what if you could assess the reward that comes with de-risking the carbon footprint of your home, but also the additional energy costs, the additional repair costs, the additional maintenance costs that come along with owning a home. But understanding, your bank understanding what that actually looks like for your overall financial position, and helping you finance those improvements, but also rewrite the underwriting of the risk for that particular loan. Those are also being developed. In fact, there are a number of companies across the UK that are absolutely interested in ensuring that your bank understands the green position of your home. They're in flight already. We haven't seen a lot of those products yet come to market precisely because the data sharing is not yet enabled in a way that can be financially sustainable for those startups. But under the smart data scheme, it would. And smart nutrition. If you actually understood what your SKU level, your point of purchase information does to help, say, your private health insurance, or even your bank understand how nutrition and access to good, healthy, whole foods would have an impact on your life, your quality of your life, but also your overall healthcare and maintenance costs. And then starting to understand how to distribute that nationally in terms of which shops need more carrots, more leafy greens, more whole grains. All of that is enabled by smart data. And there are some startups that are actually looking at smart nutrition along the supply chain and the distribution around access, well, food deserts around access to healthy and nutritional foods at the corner shop, let alone the major supermarkets. All of these different types of use cases are enabled by smart data. Now, the one thing that becomes really interesting, and this is where I've been playing for quite a while, is understanding what the foundational elements are for any data sharing economy. And at the Financial Data and Technology Association, we are intimately involved in shaping those conversations with regulators, parliamentarians, and legislators to help them understand exactly what components need to be enabled for this to happen in a safe, secure, reliable, and interoperable manner. And there's some common bits around data sharing that are absolutely required. First and foremost, I'd argue it's an explicit consumer right. That doesn't necessarily exist here in the UK, but it is inferred under GDPR. What we'd like to see is an explicit consumer data right, which basically says that if you, as an individual or a business, are the genesis of that information, it is yours to do with as you will. And if you want to share that with a trusted third party, that is your right. And that any institution or firm that holds your data doesn't own your data, it is merely a custodian. You have the right to maximize the economic value of that information on your own behalf. And in order to do that, you need explicit ownership rights. I don't hear an argument against it, so I'm hoping that you all agree with me. The second is interoperability and scalability, and that is pretty much from a technical perspective. You need processes and infrastructure in place that can speak to one another, that can facilitate the mobility of data at speed and scale, because that is what generates growth, the mobility and portability of data at speed and scale. If you can do it, if you have that right, and if you have the infrastructure that allows for that, that actually means economic growth. The fourth principle is digital ID. In this particular country, it is a bit of a challenge. There's a cultural reticence to adopt a digital ID, but we're still working on overcoming that. But we see in all open markets a digital ID that allows for you to authenticate who you are without having to provide some sort of physical evidence, and to authorize an action that you'd like to take with your data is crucial. Now, I'm a bit of an anomaly because I do have multiple digital IDs in different jurisdictions in which I've lived, and I've got an extra one. I've got an Estonian digital ID. So I can prove who I am with a couple of different passports, a couple of different permits, and a digital Estonian ID that I exist and I am Gela. But what we don't have now is a national digital ID. We're working at sort of introducing the idea. DCIT has a particular program in place based on digital ID and rental access that they're testing out now. But the banking industry is also looking very much at providing a proxy digital ID. And I would argue that KYC is the first step for this country and for this industry to help us get to a fundamental digital ID that can be used across different sectors. The other thing that is needed is consent. And in fact, nothing happens without consent. And that is you that grants it, and it's your permission that allows you to do these different things. So, given that we need these 4 foundational things, consent is an ongoing conversation, la-di-da. In any case, my request is to meet us at the intersection, be ready for it, and if you are building a business and solution, start looking outside of finance to gain insights and potential inspiration for where you can take smart data next. Because I want to remind you, the future of FinTech is not finance. And now, Julian.
Thank you, Gela. Oops. Knocked the battery out of the Clyde Slicker. Good job. There's no more slides this side of lunch. If anyone wants to talk to Gela, she'll be around at lunchtime and this afternoon. And it's time for our next speaker. So it's a great pleasure. It's always a great pleasure to introduce our chair, Chris Sear. Particularly great pleasure today because we haven't had him at very many of our events this year. He's had a fairly tough year, I think is an understatement, Chris. It's brilliant to have you here today. It was great to see you last night as well, and really delighted to welcome you to the stage.
So, hello everyone. I'm, as Julian says, Chris Sear. I'm the chair of FinTech North, and it's always the same. Good old Chris, he'll fill in. We'll give him 15 minutes. He can organise himself around that, but there's a gap in the agenda, and he'll do it. And then what happens is there's never a gap in the agenda. And I'm told I haven't got 15 minutes, I've got 3. So, so I'm going to wing it and see where I end up. So everybody wants to claim that they have a connection to Newcastle. I'm going to do exactly the same, but I have a real one. I graduated from here with my PhD about 25 years ago. And on the basis of that, I'm going to try and make 3 relevant points to you that I think you might find quite interesting. The first is stick with what you're doing, no matter how confusing it is to everybody else. Now, my PhD supervisor was a guy called Professor Peter Olive. And Peter was an invertebrate reproductive biologist. Now, what that means is he basically looked at the life cycle of worms, specifically lugworms and ragworms. And Peter, as my supervisor, I was looking at coral reproduction in the Indian Ocean. I spent most of my time working with the UN in the Indian Ocean, Maldives and Chagos and Laccadive. But I graduated from here and did my research from here. He specialized in something pretty esoteric. He learnt that ragworms and lugworms manage their life cycle, manage their reproductive biology by following a number of environmental cues, things like the phases of the moon, the temperature of the water, the seasons. And what he did was he commercialized this. He commercialized it because at the time, prior to Peter coming along, the foreshores in the northeast, you were allowed to dig for your bait as a fisherman. And the foreshores were littered with holes dug by bait diggers, which essentially were ruining the environment. And so the local authorities said, no, you can't do this anymore. You can't dig for bait. And so what Peter did, learning this rather esoteric science of reproductive biology, was build the world's first ever worm farm. And he was commercially successful. So not only was he a successful academic, he was a successful businessman as well. And if you think you've ever had a hard job trying to pitch to your family or a VC, the esoteric thing that you may do bid in payments or let's say crypto, imagine how hard it was for him to explain that he was dealing with worm reproduction. But it worked. So there's the first lesson. Don't be intimidated by what you're doing. It may be incredibly esoteric, but it may also be incredibly valuable. And just because your friends and family don't understand it doesn't mean that a VC won't. So, second learning. Has anybody here heard about the deal of BlackRock buying Preqin recently? Let's see a show of hands. I can see the audience. Okay, two people. Right, so pay attention. This is important for everybody. Preqin is a data company started by a guy called Mark O'Hare about 20 years ago. And what it did was it looked at something particularly esoteric, which was data that existed in the institutional fund management space. So I dare say there are some wealth techs within the audience, and wealth tech looks at the retail side of the world. I'm forever telling people, forget about the retail side of the world. There are lots of people looking at it. Look at the institutional side of the world. In comparison to the retail side of the world, the institutional fund management market is some 5 times larger. There are over $120 trillion of assets under management in the retail fund management space. BlackRock has about 10% of that. It is an enormous space, and it is untapped, it is confusing, it is utterly opaque, it is enormous. And Preqin, the acquisition of Preqin, should, if nothing more, tell you that this is a space that you should pay attention to. There are only 2 companies in the world that look at the space that Preqin occupies. Preqin is one of them, and it was bought by BlackRock 2 weeks ago. Now, the 2 people in the audience, do you know how much it was bought for? It was bought for $3.5 billion. It is a 20-year-old data startup. It has never turned a profit. Its revenue last year was £140 million. It has turned the founder, Mark O'Hare, who earned 80% of the equity, into a $3.5 billion. My apologies, it's £2.5 billion. $3.5 billion. It has turned Mark O'Hare into a 3 times billionaire overnight. He was the CEO and founder of a data company that looked at an incredibly esoteric space, collecting data from private equity funds that only a very small portion of the institutional market looks at. So here's the second lesson. Start looking and fishing in ponds that are big and otherwise unfished. And I would say the institutional asset management market is one of those. And the third is the price at which it was bought. So the price at which it was bought, most companies are valued on EBIT when they're bought by a strategic buyer. He has no EBIT, never has. He's never turned a profit. He's only had revenue. The remarkable thing is that the price that was paid on a multiple of next year's revenue estimated rather than last year's revenue proven. The price was valued on a $250 million basis. This year he has $140 million, or last year he had $140 million in revenue. Next year he's estimated that he had $250 million pending, and BlackRock said, okay, we'll take that as the basis of the valuation. The next is the multiple. Now, currently in the marketplace, data businesses, particularly in this institutional space, or certainly in the fund management space, even the retail space, are going on a 10 to 20 times multiple of EBIT. His company was sold on a 14 times multiple of future revenue for cash. No earnout, no shares. BlackRock has had to extend a debt, has had to issue debt to pay for this company. So what I want you to think about is what they have done is set the standard, the new high watermark for valuing data companies in this space. The new high watermark is 14 times future revenue entirely for cash. Fish in the pond that's biggest and with fewest people. That's my advice. Right, we'll move to lunch. I've tried to truncate it. Thank you very much indeed. Actually, it turns out that we're not moving to lunch. Julian's rushing up to tell me that Dan is going to be speaking. I tried really hard to talk into Dan's time. I failed. Sorry, everybody. Dan, over to you.
Thanks, Chris. That was awesome. What a story as well. I know there's some data businesses here, so I hope that proves to be very helpful to you guys. Joe did an overview of FinTech North's evolving strategy earlier on, and talked about the ongoing focus on events and building the community, the international trade angle, and also skills. And Dan, who's along with me as one of the directors of FinTech North, has been leading a lot of the work on skills. He's just going to do a super quick overview of what we've been doing, and then it'll be time for lunch.
Thanks very much. Right, I won't keep you between lunch for very long. I just wanted to give a really quick update because we're making a lot of developments on the skills initiative. So it was last summer where we decided actually it's really important we engage with education providers and the upcoming talent and employers in the region to really help upskill people into the sector. And this is something that's dear to my heart. I run a couple of FinTech businesses, as well as being a co-founder of FinTech North. And I'm always investing in training. I'm always upskilling graduates into understanding the different areas, helping to kind of balance their understanding between the fin and the tech to give them a good range of skills that they need. Quite often, it can take years to get them to a really good proficient standard. And because those skills are kind of quite rarely taught in the blended way that we do, they become really valuable to industry and achieve significant premiums on their pay, which is absolutely a great outcome. We want to kind of continue to support that and endorse it, but it makes more sense to do that as part of FinTech North and as an industry than as I have been with an individual firm. And so we've created a skills steering committee. We've got some really good stakeholders and supporters who volunteer their time. Stephen Keevan and Kevin Telford from the region are really good advocates and supporters of this steering committee. And just to give you an idea of some of the achievements, we said that we wanted to be able to create a FinTech apprenticeship in conjunction with iFate, with Ian Bolton, who from Tech Skills UK, who is a fantastic stakeholder in supporting the lobbying work we've done with iFate. And I'm really pleased to announce that they've confirmed, they've given us a pre-authorization, which means they're going to work with us to create this apprenticeship over the coming months. And this will be something that comes into the apprenticeship program, which employers can use. We've hired our FinTech upskilling assistant who's helping to prepare some resources and create some courses to help graduates understand the different subsectors in FinTech and to get them excited about why they would want to pursue a career in FinTech, which is a great way to advertise and promote the market to people thinking about what they want to do. One of the really attractive facets of FinTech is that it's multidisciplinarian. So you can learn a lot of skills in connection with various areas in data analysis, in understanding crypto assets, in innovative regulation. So it prepares somebody, our vision is that it will prepare somebody really well for being a valuable asset in those organizations. And we've also taken some of the research that Whitecap did in May. They published a kind of a skills like demand analysis with different employers across the North and came up with 10 core competencies. So we're leveraging that to embed it into the skills that we're going to develop in these apprentices and in the young people as they go through the upskilling program. So I would encourage the employers in the room to share their training resources or to engage with us to assist with encompassing that to the extent that you're happy to do. Obviously, not necessarily training people on USP or specific secrets, but by investing in this resource and making it available and accessible, we hope that the candidates who apply for your jobs will be better prepared and impress you with the breadth and depth of skills they have in interview and early on in the roles that you take with your firm. So please engage with us. It's a big mission, it's a big undertaking, but we're really enthusiastic by the support that we've had, the demand from industry and the engagement from the sector, from the young people who really want to get into it, develop their knowledge and hit the ground running in the companies that employ them. All right, so that's it for me, but I'll give periodic updates at the different FinTech North events about how these initiatives are developing. And please engage with us. Reach out to me, Joe, Silas, or Julian. I'd be more than happy to let you know more about what we're doing and how you can get involved. Thank you very much.
Thanks, Dan. Cool. I'll keep this super quick. I know we said there's going to be one more speaker about 3 times now, but yeah. That wraps up this session. As I say, I won't keep it very long. Thank you to all our speakers for the past session. I'm not in the camera, am I? Brad's going to shout at me. Yeah, so it's lunchtime. We're in the same room we were before. We got it till 22:01, I believe. And after the break, we're going to hear about the impact of FinTech. We're going to have a panel discussion talking about how we're making the Northeast a world-renowned fintech cluster. After that, we're going to hear about how ScottLogic are building fintech services for critical national infrastructure, and then close with a fireside chat with Google Cloud and ScottLogic about scaling up fintechs before another break. So yeah, we'll keep you any longer. Thanks again, and come back in here at 20 to 2. Thank you.